Have you got to the end of your financial year and your accounts say that you've made a small profit? You may even have a small tax bill to pay, but then you look at your bank account and there's no money left, like no money, not even enough to pay yourself. And you're wondering, how is it possible that you've made profit but there's no money? Well, that's because making profit is different to generating cash in your business. So your profit and loss statement typically shows you how much profit you've made by looking at how much income or sales you've made versus your costs. But you also have two other financial statements that are really important. One of them is called the balance sheet, and this typically shows you the assets and liabilities of your business. And what that means is this shows you things that your business owns and things that are owed to you by other people. So they would make up your balance sheet. And then you also have the cash flow statement, which shows all the money flowing in and out of your business. Now, as a business owner, it's really critical to understand how these three financial statements link together and paint the entire picture of how your business is performing. Otherwise, you will end up in this situation where you are at year end, where you've made good profit, but you don't have any cash to pay yourself. And this isn't just a year end problem where you've made profit but no cash. This could happen at any point in the year. For example, if you find that you run out of cash and you can't pay any bills, or you want to expand and you're wondering about how you can afford to do that. So understanding how these three financial statements link together is a really, really important part of building and growing a successful, profitable business. Especially as your business grows and it becomes more complex, the need to understand your finances becomes even more demanding. But if you're thinking about maybe getting some external financing in your business, perhaps you want to get investment one day, or even a loan, or maybe you want to sell the business eventually. All of these three things will require you to understand your financial statements and, more importantly, how they all interlink together. So I'm going to break that down for you into the simplest terms possible, and we're going to walk through some real life scenarios so you can see exactly why your profit and your cash may be out of sync. So if you're interested in content just like this, make sure you hit that subscribe button down below and also like this video, as it just helps the algorithm to share it with more people. Okay, so I've mentioned that you have three financial statements. You've got the profit and loss, the cash flow, and the balance sheet, okay? And they all show you slightly different things about what's happening in your business. So we're going to start by having a look at the most simplest of scenarios, and that is that you make a cash sale. So I want you to just imagine that you're going to make a sale for £100 and you're going to pay around £40 for the purchase of that product. Now, in simplest terms, if you buy the product for cash and you sell it for cash, then everything happens instantly. Therefore, being left with a £60 profit on our profit and loss statement. And we've also got the corresponding transactions on our cash flow statement because we've paid cash for them, so they've immediately impacted our cash balance. So in this simple scenario, we can see that our cash and our profit are both aligned. But what would happen if your customer didn't pay you immediately and your customer, for example, paid you in 30 days time? So what we actually have today is we still have the money going out of the bank account for our purchases, so we're still minus 40 on our cash flow, and our profit hasn't changed because we've still made a sale and we still have costs related to that sale. But what we do now have is we have an asset of £100 because the customer owes us that money in the future. So we can see that £100 actually goes onto our balance sheet here. And this is a really common scenario that occurs in lots of businesses where their cash and their profit is now misaligned. So we've made £60 profit, but we've got minus 40 on our cash flow. And this is why it's so important that you understand how these three financial statements link together, because we can see in real life terms here how this scenario just immediately creates this cash deficit in your business and will make it very difficult for you to continue trading. And once you understand how these three statements link together, then you can use this information in your business to be making smart decisions on a day-to-day basis. So when, for example, a customer says, "Can I have 30 days to pay you?" you can have a look at your cash balance and decide whether you can afford to do that or not. So now let's walk through some more everyday scenarios that occur in small businesses that will result in your cash and your profit being misaligned. So we're always going to start again with the three financial statements, and at the moment they're blank because we haven't done anything. But in this scenario, we want to have a look at stock. Stock is actually classed as an asset asset in your business because it's something that you own. So imagine that you go and buy £1,000 worth of stock. So what we have is we have £1,000 go out of our bank account and we enter that onto our cash flow statement, and we have plus £1,000 on our balance sheet because we now own £1,000 of stock. So you can see again in this scenario with this purchase of stock that actually this has had absolutely no impact on our profitability at all, but our cash flow has been impacted by minus £1,000. And this balance between cash and stock in stock-based businesses can actually be one of the biggest financial challenges that these businesses face on a day-to-day basis, because typically you're paying upfront for stock that you'll hold for a certain amount of time. So managing cash flow versus stock in your stock-based businesses is a constant challenge, particularly for small businesses that don't have access to multiple different streams of income and finance products. So a second really common scenario in small businesses is the purchase of fixed assets. And similar to stock, fixed assets, is in the name, is an asset, so it goes onto your balance sheet. So it means you have this immediate outlay of cash when you buy the asset, but you don't have any impact on your profit and loss statement. So let's have a look at the scenario where you bought a new laptop, say for £600. So we have minus £600 on our cash flow and we have plus £600 on our balance sheet, and there's no change in our profitability. Now this is actually a really common scenario, particularly for brand new businesses and small businesses, is that they have to buy computer equipment and other things like machinery to get their business off the ground. So they have an immediate outlay of cash before they've generated any revenue or money into their business at all. But what's really important with fixed assets is that you understand the longer term impact of this on your profitability. And that's where depreciation comes in. Because when we buy something like a laptop, we intend to use it over many years in our business. So let's say, for example, we intend to keep the laptop for the next 3 years in our business. What we want to do is spread the cost of that laptop into our profit and loss over 3 years. So what we'll do is we will depreciate the asset or write off part of the asset over the next 3 years. So we see this impact minus £200 expense into our profit and loss. So you can now see how the impact of that initial £600 hit our cash immediately. It's going to hit our profit and loss at £200 per year. And that's really important to understand, because initially you have this cash outlay, but then you have an expense over the next 3 years. You've got £200 per year where there's actually no cash flow related to that. So that's a scenario where you have an expense but no cash flow. So the timing of fixed assets in your business is really important to think about and plan appropriately. If you're talking about smaller purchases that are a few £100s like a laptop, you might not need to think so carefully about this. But if you're a business that relies on plant and machinery and expensive equipment, it's really important that you are planning ahead for the timing of these expenditures because of the initial impact that this has on your cash flow. Particularly businesses that have really high value assets, this can be quite a challenge for. I actually work with a business that's made over £1 million in profit in the last 5 years, but they don't have any cash in the bank because they reinvested it all in really high-tech specialist equipment. So this is a really good example of where you can make loads and loads of profit, but there is just no cash in the business to enable you as the business owner to extract this profit out of the business. So the final scenario that I want to walk you through, which I think is quite common for a lot of businesses, is when they have a loan and they're making loan repayments. What happens when you have a business loan is that you get this initial flow of money into your business when the bank or whoever it is that's loaning you the money sends you money. So let's say, for example, you get a business loan for £20,000, you have plus 20k come into your bank account, but you now owe £20,000, so that's a liability and that hits your balance sheet. Now over time you're going to make repayments on this loan. So for example, you pay £550 per month, so you pay minus £550 out of your bank account every month. But actually this is a split between a repayment and an interest. So if anybody's got a mortgage on their home or anything like that, they'll understand this, or they've had a credit card bill. Every month you're generally repaying a portion of the loan plus some interest charges. Let's say the interest charges are £50, that goes into your profit and loss because it's an expense, and the remainder is paying off the loan, so we're reducing that liability and that goes onto your balance sheet. So we can see here that a loan repayment actually impacts all your financial statements. You've got money going out of your business, your cash flow has changed, you've also got an impact on your profit and loss statement because you've been charged interest for the month, and you've also got a change to your your liabilities too. And I think that this is probably one of the most confusing elements for business owners to understand. So if you've got a finance product in your business like a loan, and you think that you are making profit but you don't have the cash flow to support it, then this could be an area where you need to understand better the connection between cash flow and profitability in terms of your business loan. So the way the three financial statements, the profit and loss, the balance sheet and the cash flow, link together can seem really, really complicated.
I am not really a math guy, you know.
And I'm not expecting you to watch this video and be a complete wizard here and be able to understand every scenario in your business. But what I do want to do is raise your awareness of this, and over time start to build your confidence so that you understand how these link together and you can understand the impact of the decisions that you're making in your business on a day-to-day basis. So if you've got a digital bookkeeping system like Xero, QuickBooks, ClearBooks, anything like that, these systems can all produce these three financial statements for you on a monthly basis. So get them out of your system yourself, or have a word with your accountant and bookkeeper and ask for your financial statements every month. Just simply go through and have a look at the key movements and ask yourself, what was it in your business that caused these numbers to change? So did you buy something? Did a customer pay you late? Did you have to pay a supplier late? Questions like this that will help you understand, and always look to see where those key business elements have impacted your financial statements. So make sure that you're practicing this on a regular basis. I always recommend that every single business is reviewing their financial statements on a monthly basis. So at an absolute minimum, your profit and loss, but I highly recommend reviewing your profit and loss, your balance sheet and your cash flow statement together. Sit down, have a look at the numbers and ask yourself what's been happening in your business to make these numbers change. So have a look, for example, at your profit versus your cash flow. Are they moving in the same way together? Has one gone up at the same rate as the other? And if not, why not? And if it's a problem for you in your business, i.e. you don't have enough cash, ask yourself what you can do to change that in your business. And this is exactly what financial management is. Financial management is the art of understanding your finances in your business so that you can make smart decisions on a day-to-day basis that helps to increase your profits, improve your profitability, and ultimately to grow your business. So if you're interested in content just like this and you want more hints and tips from me, a chartered accountant, then make sure that you subscribe to my channel, hit the like button, and don't forget to join me in my free Facebook group.